Okay, so we're picking this up again, and we're on slide number 17, and we're talking about who is a real estate professional, because it's just not real estate salespeople. It includes developers, construction people, leasing people, engineers, architects. So the way they defined real estate professionals was very broadly. So the Internal Revenue Service, our lovely adversaries, bring a case against a real estate salesperson a number of years ago. And the IRS claimed that this salesperson could not avail themselves of the magic wand bypass of the passive loss rules because they weren't a broker. The mean-spiritedness of it all. Has it dawned on you? Okay, the mean-spiritedness of it all. And fortunately for everyone in this room and in online, watching online, the IRS lost. So there's a judge that ruled that whether you're a salesperson or you're a broker, you can avail yourself of the passive loss rules dealing with being a real estate professional. And that makes for a very interesting conversation, because the IRS in this David and Goliath fight has certain disadvantages. We always think of Goliath as so large that they win all the time, but that's not the case. Goliath has a tendency to be slow. They have a tendency to be ultra careful. They're used to winning, so there's a degree of arrogance that comes with being a Goliath. And in the IRS's case, they've got to win 95% of the time. So I used to love that. That's because when I first started out, now I specialized only in tax preparation, in preparing people's income taxes and doing tax consultation. But when I was younger, I fought with the IRS as a litigator. I was a born litigator, completely different than you. I'm a born, trained litigator. So I believe that I can win 50% of any argument. I was a debater on the USC debate team. I can win 50% of anything. I only have to put 5% of fear into my adversary, and they're going to want to settle. This is a fantastic, this is part of turning the game to your skill set. Now, we talked about this magic election, which is on slide number 18. This magic election is under IRC 469C7A. You know, my dad knew nothing about taxes, the technical part of taxes. He couldn't tell you one section versus the other. Where my dad was a genius was by feel, kind of a street kind of knowledge as to what the computer of the IRS was looking for, what you could push certain things, certain finesses that you could do. This is not easy to be taught. And when my dad was teaching me to gamble and teaching me the don't side of the gambling and other things, he came to me one day and he says, Harold, I was probably 13 years old. Harold, maybe 14. We're going to have the talk. So every guy in this room knows what the talk is. Dad, we're going to have the talk. And I'm thinking to myself, thank God he's going to tell me about girls. I mean, this is fantastic. So he takes me into another room, and he sits me down, he says, are you ready for the talk? I said, Dad, I am so ready for the talk. And he says, here it is. When in doubt, deduct. I said, that's it? That's the talk? He said, what about girls? I said, what about girls? He says, oh, no, I don't know anything about girls. I got to talk about, so when in doubt, deduct. So that's where we are now. We're at slide number 19. And we're talking about expenses. And we're talking about packaging yourself. And we're talking about packaging yourself as a reasonable person. So a reasonable person doesn't deduct a trip to Paris. Okay, why? Because if you get audited, the auditor will never have gone, most likely, never gone to Paris, will be jealous that you went to Paris. How good is your documentation? And they're going to kill you because you're a what? You're a pig. My first pig story. I got 2 pig stories. Ready? My pig stories. I get a call about 10 years ago from a client. Client says, Harold, I'm so upset. I just got visited by an IRS agent. I said, an IRS agent came to your business and they didn't let you know beforehand that they were coming? No, the guy just showed up and he sat down in front of me, scared the hell out of me. Well, what? And every time he would tell me something, I'd get more incredulous. Okay, so my voice just keeps getting more incredulous. So Harold, he sits down and he shows me his gun. I said, what? He showed you his gun? He showed me his gun. He told me he was licensed to carry the gun and that I owed the Internal Revenue Service No, wait a minute. Stop it. Let's go back to the gun. Okay, an IRS agent comes into your office and he shows you a gun and he tries to collect money. Is that the story? That's the story. So I call up the supervisor of the collection division here in Maui, and they all know me, and I say, okay, does this guy work for you? Yes, he works for you. And I say, okay, I think I can resolve this just between him and me. So I call the guy up and I say to him, look, this is what my client told me. He said, yeah. I said, look, right down the hall from you, they were at One Main Plaza, is the FBI. Get up from your seat, go and put an application into the FBI so you can wear your gun. But don't be wearing your gun as an IRS agent, because if your supervisor found out that you were carrying a gun and showing it to my client, you would lose your job in about 3 seconds. So a couple weeks go by. Me and Roz were up in Kula. We're having a late breakfast or early lunch at 808 Cafe, which used to be up there. And in comes the guy. He's wearing fatigues. And he's got a Bowie knife down to his kneecap. So, of course, I'm always trying to be pleasant, although it's hard to believe. I knew it. I knew you were going to laugh. Okay, I try and be pleasant, although it's hard to believe. And I say to him, hey, man, what's going on? And he says, oh, you know, blah, blah. I said, so what's with the fatigues? And he says, oh, I was just pig hunting on the side of the mountain. So he leaves, and I turned to Roz and I said, this is so incredible. This guy hunts humans during the week, and that's not enough. On the weekend, he goes up on the side of the mountain to hit, to hunt pig. Okay, now the reason I'm telling you this story is so that the word pig stays in your consciousness and you never become a pig. So here's my second pig story. When I first moved to Maui, I had a girlfriend, very attractive. She was a horsewoman. She was dressage and a hunter jumper and a polo player, and all the Portuguese guys liked her. So her brother was visiting and they invited us to go on a pig hunt. And of course I'm thinking, I'm Jewish, what do we know? We don't know anything about pigs. So they take me up to the side of Haleakala, 7,000 feet, and they run me up and down jungle gullies trying to kill me to get the girl. Okay? So here it is. Don't be a pig. Okay? Don't be a pig. Okay, so looking at this slide number 19 and going through this, and we say, what can Harold can package anything. Look at this guy. He can package. What can Harold not package? I'm going to tell you. I cannot package a tax protester. It's impossible to package a tax protester. So the one thing you are not to be is a tax protester. You cannot be in the United States of America, live in the life that we're living here, under laws, under due process of law, the Constitution of the United States, and not pay our income taxes and somehow think that that's okay. It's not okay, so stay away from it. You've already lost on Maui one of your own to 4 years of doing time for being a tax protester. Don't you fall into that garbage. It's a garbage dump. Don't go there. So you want to take reasonable stances on your tax return. You want to be aggressive. When in doubt, deduct. But you don't want to be a pig, as our stories of pigs. Okay, so here's the issue. I spent a lot of my life searching for the truth. It's been a very, very serious endeavor of mine. And when I was going to Berkeley, I wanted to find ways to be in law school, get credit for law school, but not go to law school. It was kind of like, you know, after the first year of law school, it's kind of, come on, man. Okay, so there was a course being given in the graduate division of the philosophy division called The Truth. It was given by a guy who was a lawyer, and he had represented Lenny Bruce. And he had Lenny Bruce tapes, and he had traded his Lenny Bruce tapes in for ownership, part ownership of a record label that 3 weeks later signed CCR, Creedence Clearwater Revival. This guy was making millions, okay? And it was the most incredible class. He talked about John Lennon and Bob Dylan. We studied lyrics. We studied the greening of America. I had met Krishnamurti in Gstaad, Switzerland, so I brought an Eastern philosophical approach to the truth. So in dealing with the IRS, I talk about the truth a lot, something that they're not interested in. What the IRS is interested in is verification. They don't care what the truth is. You might have gone on that airplane, you might have gone to California, and you might have done business. They're not interested. Can you prove you got on the airplane? Can you prove that you went to California? Can you prove that you did business? Verification of reality. So I say to them, we're into finding the truth. We're into finding the true liability. We're into finding the truth of applying tax law to the particular facts and circumstances that we're dealing with. And they look at me like I'm completely from a different planet. And then I say, look, I have affidavits for you, statements of my clients as a form of proof. And they say, oh, we're not going to, the agents at the lower level, we're not going to take affidavits. Why? Why wouldn't they take affidavits? Because they believe that every taxpayer is a liar. So why would they believe you? Here's the beauty of it. Well, there's a couple beauties of this whole thing. The first is, if you read case law, you can tell almost immediately who's going to win and who's going to lose. If the taxpayer is a CPA or a lawyer, they're going to lose every time. There was statistics at one point in which half the people in jail for tax fraud were lawyers or CPAs. They love to hang lawyers and CPAs. But if the judge starts talking about credibility, the taxpayer will win. If he says the taxpayer was credible, which means what? He testified, oral testimony, affidavit. Okay? So judges will listen to affidavits. The revenue agents will not listen to an affidavit. So I've been seeking truth with the IRS, a daunting task for 39 years. And I'm convinced that the IRS has a rule that none of their agents should read the Constitution of the United States because they don't want to infiltrate their brains with issues like due process of law. There is a case called Love versus the Internal Revenue Service. The IRS had gone to Congress 6 years in a row in order to oversee the industry of tax preparers. And 6 years in a row, Congress had denied them this right. Why? because the IRS in their going to Congress said that the IRS will be judge and jury. Okay? So you couldn't appeal your being kicked out of the industry to a federal judge who would have to say whether that was. So where's due process of law? Where is due process of law? Due process of law is nowhere. So this woman who did 100 tax returns at her kitchen table decided to challenge the Goliath Internal Revenue Service. She brings a lawsuit with her and 2 other people, both of them very small preparers, and they win at the district court level. The Internal Revenue Service appeals to the Ninth Circuit Court of Appeals. How could these women win? How could they win against the Internal Revenue Service? The Ninth Circuit Court of Appeals. Taxpayer won. So there's nobody overseeing the industry of tax preparation. All of these PTIN numbers that have been given to tax preparers are useful to track the tax preparer, but there's no like rules and regulations in the industry as far as what to do if somebody's bad. So this is the state of the art in the industry right now, and the verification of the truth is where the IRS is at, and that gets us back to what? Documentation.
Carol, I'm sorry.
Go ahead.
I have a question that I just have to ask. It may not be pertinent to your class, but I listened to you about what you just said with your little personal calendar. Could you answer a question, or would you attempt to answer the question that is involved in politics right now with Trump not being able to disperse or show his taxes because he's being audited and has been?
Cindy, that was the longest freaking question in the history of mankind. The question is a political question dealing with our good friend Trump, who is not giving his tax returns to the public, and whether I would comment on it. The Internal Revenue Service has come out and said, we don't care if he discloses. He's under audit, which should not be surprising. He makes a lot of money, and of course they do audit people like Trump, but they audit all kinds of people that make no money. So the fact that Trump is being audited is not necessarily a black eye for him. He can do that all by himself. And I say that look, here's the real issue for taxation and people in this room. If Clinton is elected, we will have a very complex tax system. Will continue. Because the Clintons believe, as do most Democrats, in using the tax system as an incentive to get somebody to do something. So if I want to get you to buy solar energy or a solar car or an electrical car, or I want you to do something, all I have to do is build something into the tax system to give you the incentive so I can control your behavior, because I can control your behavior with money. Trump is a different animal, and that is that we don't really know what he would do. And I don't mean that. Look, everybody has the right to their opinion, and there's different political beliefs, and I have 2 daughters, so I think you could figure out what I think about it personally. But professionally, I have no idea. I know he wants to reduce corporate tax rates down to 15% from 35%. How's he paying for that? Yeah. Puppy. Number 2 is he wants to reduce personal rates at the highest level, not the lowest level, the highest level. So we have 2 different philosophies that exist between the 2 candidates. And I think that Trump is a wild card. He's like the joker in the deck. We have no clue what his administration would look like, and we have no clue how it would affect you as a professional. Now, he is a developer. So if you were a developer or you represent developers, then Trump would be most likely to have favorable tax advantages given to developers, okay? Because he is a developer, and he's tired of paying ordinary income, and so he's going to give what? Capital gains treatment to developers. And what else is going to do? He's going to allow installment sales for developers that don't exist. So that's my elongated answer to you, so you can get a feel for the two issues.
I'd like to hear the end of your story with the gun-toting IRS guy. Did
He-
your client have to pay that?
Okay, the answer to that question is he's still here. You ready? He is the head of collections on the island of Maui. He got promoted. Okay, he got promoted only because I think it's hard to be an IRS agent. Okay, let's be real. Everyone in this room is very sociable. You go to a party, you're hanging out, you can have fun with people, blah, blah, blah. And then the guy's sitting there or whatever, and you say, well, what do you do for a living? I'm an IRS agent. The room empties. These guys are pariahs. These guys can only hang out with who? Themselves, the other IRS agents, right? They understand each other because they're pariahs. So it's difficult. They have a very difficult job. There's good people in every profession. There's good IRS agents. We just lost one. His name was Carl Van Sweden. He just retired. Carl was as good an IRS agent as you could dream about. He was fantastic. And Jeff knows Carl, and Carl is just fantastic person. Fantastic person. So there's good people and there's bad people. There's bad people in tax preparation. We just had a guy now kicked off the island for making bogus tax returns for people and hurting people. All right, but let's talk about this for a second. Talking about bogus tax returns. Okay. Now, I don't know. I'm not saying that this has happened to you. But there are robotic calls that are being made where the person on the phone is claiming to be from the IRS, and they're saying that you owe them $50,000, and they're going to throw you in jail, but you can make a $10,000 payment. What's your credit card? Oh, and what's your and they get along to Social Security, things like that. So it happens that 60 Minutes did a segment on tax fraud. And they found that the vast majority of tax frauds in the United States come from the state of Florida. So there's something about Florida. We know they don't know how to vote. Okay, but there's something about Florida. Either it's the New Yorkers that escaped to Florida, or it's the Floridians, or it's in the water. But I'm telling you, okay, what do they do in Florida? You can, for a certain amount of money, and it's not very much, you can go to people in the medical field and buy Social Security numbers and names. And then they invent the kids, and they get the Social, and they get that from the people, and they create earned income credit. Okay, and they get these huge refunds from fraudulent tax returns. And here's the government of the United States that a couple of years ago sent 400 refund checks to a prison. Okay, so I don't think it was Lompoc, but it could well have been Lompoc. Okay, how many refund checks do you send to a prison address before you start thinking, well, wait a minute, what kind of income does a prisoner have? And what kind of tax return does that look like? And my God, look at all the people that have committed fraud that are in jail. Perhaps they're all getting together at recess and talking about how they're going to defraud the Internal Revenue Service. So earned income credit is a very important part of the tax law. And basically, it's for low-income people that have children. And it's a good idea. It's a safety net. It's a way to have welfare within the tax system, to get money to the lower end of the socioeconomic scheme, because those people will spend the money, and it's trickle-up economy instead of trickle-down economy. Okay, so people who have money will always vote for trickle-down economy, where the rich get the money and somehow they're going to spend it. But it has been shown historically that it doesn't work. What does work economically is trickle-up economy. You give it to people who will spend it, and they will spend it and businesses will flourish. And from the flourishing of businesses, improvements will be made, etc. So here's the IRS, my friends at the IRS, and they don't require businesses to send in copies of the W-2s that they've given their clients until later in the year. And yet, there's processing of tax returns with fraudulent W-2s that are being made up, and they're issuing these refunds in February. Okay, so, I mean, does it take a nuclear physicist to say that employers should file the W-2s with the IRS by the end of January, like you do with 1099s, and then the IRS has this on file, and that they don't issue earned income credit unless they can match it up to a legitimate W-2? I mean, it wouldn't be that difficult to solve the fraud. So it's extremely frustrating for me to look at this issue and say, hey, you know, these things can be solved, and yet they continue to exist. So you see on your call recognition on your phone, if it says FL Florida, don't answer the phone unless you know people in Florida and have family in Florida. And don't talk to anybody from Nigeria. All right, I'm going to talk about 1099s. A young lady asked me at the break about 1099s and 1099 miscellaneous. This is not in your material. Don't look for it. It's not there. Okay, so the 1099s, line number 7 in the 1099s is non-employee compensation. You'll see it on your 1099. So here's the issue. Let's say you're a property manager, and let's say you've got 10 properties. I'll keep it low in number, 10 properties. And let's say on each one of the properties you have a client trust account, and on each one of these properties you've got maintenance, you got repair guys. Okay, so there's 3 people that have worked for each one of your 10 clients. There's 30 1099s that you have to issue. And what if you don't issue on behalf of your clients? You have to issue them. Your client's not going to issue them. You have to issue them. So on behalf of the client, out of the client trust account. So all these people that work for the property managers doing the lawn maintenance and everything like that, you got to get their social security number and their address, etc. And you have to issue now 30. What if it was 100 properties that you were managing? Now you got 300 1099s to issue from 100 different clients, maybe. Okay, so this is a very daunting task. And what if you don't issue the 1099s? Are you putting your client in jeopardy? Yes. What are they supposed to say on their Schedule E, where it says, are you required to issue 1099s? Did you issue 1099s? Okay, so here's where I think we're going. 1099s are used by the Internal Revenue Service to get away from the underground economy. It's a terrible problem for the IRS in the country that we have all this cash economy, not like it doesn't exist on Maui, you know, right? Yeah, right, Errol. Okay. So there's all this cash. So the IRS is not getting their fair share of the cash income, net income on the tax return. So what they're trying to do is shore up this huge hole in the system. The 1099s is one of those ways. The other ways is that all these credit card information, the Schedule K, goes into the computer of the Internal Revenue Service, and they can look at a business and say, oh, the business has $1 million gross, but they got $2 million of credit card receipts. Duh, maybe we got a problem here, right? So we've got this issue, and I think where we're going, looking down the line, trying to be a visionary, I think we're getting into the area of aiding and abetting tax fraud. I think that eventually the Internal Revenue Service is going to put their foot down and say, if you don't issue a 1099, you're aiding and abetting, and we want you to pay the taxes because of what you created by not doing the right thing. So put it in place now. Put your system in place. And by the way, I do a lot of thinking and writing. Do a lot of thinking at 4 o'clock in the morning in my REM sleep state between being awake and being asleep. And so one morning at 4 or 5 in the morning, I sat down and wrote certain questions that Harold Berman would ask. Harold Berman, sitting right here. This is where I would sit. I'd sit right there. Actually, I'd sit right there. Okay, I'd sit right at the great seat. And what was the number one thing I would ask Harold Berman? What's the easiest way for me to lose my real estate license? This is your ticket to ride. This is your professionalism. And you guys have come a long way from 40 years ago. 40 years ago, it was like the Wild West on Maui. People were giving price points away, and they were talking too much, and dual agency was running amok, and nobody knew what it meant. I still don't know what dual agency means. Okay, and all these things were happening. And when I sat down and thought about how I would answer my own question, there's actually there's one major answer. You put your hand in the cookie jar, the client trust account, and you drag out money that's not yours, you will lose your license. We all get on Maui, in Hawaii, we all get the monthly commission report. We don't read anything at the front. We go right to the back and see who got in trouble and for what, okay? We can't help ourselves, right? It's like we're being drawn. It's like a moth to light. We gotta know. We gotta know. Did you notice how many DUIs there are? Perhaps there's a drinking problem amongst real estate professionals. So 1, you don't drink and drive. Number 2, never, and I mean never, put your hand in the cookie jar. I am amazed that 2 months ago they started talking about all this embezzlement that was going on by a real estate professional, and it wasn't even in real estate. She was handling some pony league thing and stole $77,000. I mean, I'm just going in the back of my memory. Stole $77,000. Are we back to being a pig? Okay, we're back to the pig story. $77,000 she stole from pony league team. I mean, where was this person? And they're talking about taking her license. I think they're going to take a lot more than her real estate license away from her. Okay, obviously embezzlement. She's going to jail. I don't know who the person is. They're going to jail. And you read about these embezzlements, and you're scratching your head. But it does occur. I had a friend of mine who went to accounting school with me at USC. And I was like a prodigy in that my dad was a CPA. I knew a lot just from the dinner table. I seemed to have this strange feel for things. And as a junior at USC, this guy showed up out of the blue. His name was Lowell, and Lowell had long hair. And at SC, which was one of the most conservative schools in the country, nobody had long hair. And so he shows up, who is this guy? And he wound up to be, he was a bass player in a band, and he had long hair. Oh yeah, and he smoked dope, and he was kind of wild and everything else. And Lowell went to UCLA when I went to Berkeley. I went from one of the most conservative schools in the country to Berkeley Law School. Man, the sky opened. The sky opened. I turned down Harvard to go to Berkeley, but my father just didn't get it. I tried to explain to him that there was a bunch of girls at Berkeley. They're just waiting for my arrival, and I was never going to get any action on the East Coast going to Harvard. So I went to Berkeley, and so I wound up on Maui, and then Lowell wound up here on Maui. He's a lawyer here on Maui, and I saw him one day. It was about maybe about 10 years ago, and he was outside Sports Authority, and I hadn't seen him in years and years. We had parted ways, and he wasn't a friend of mine anymore. And I went up to him, Lowell, what's happening, man? He said, things aren't good, Harold. And so he starts telling me he had lost his law license. And I said, how did you lose your law license? And he started to tell me a story. You can never believe the person telling the story, because the story will be bent to make them look better than the reality of what really took place. So as a lawyer, you know never to believe everything your client tells you. But Lowell told a story about how he represented, everybody would know the name of this client because of this person, the business is a well-known business here on Maui, and Lowell diverted some of the client trust funds to his operating account, and he was disbarred. So I don't want anybody that's sitting in this room or watching online to put yourself in the position of losing your ticket to ride. The real estate license is your ticket to ride. Don't put your hand in the cookie jar. Now I have, pardon?
Was he advising the Sports Authority?
The question was he advising Sports Authority, which we know now is bankrupt, right? So that's the reason for the question. So they closed all their stores. So no, he wasn't. It wasn't a Sports Authority story about that. But I do have a fantastic 1099 story to tell you. And the reason I'm telling you this story, it's a war story. So it's a war story. It's one of the litigation things I did in my career. And it's a war story, and it's about 1099s. And the reason I'm telling you the story is to show you the importance of 1099s. So a guy comes to my office about 25 years ago with his son, and he's from the Big Island, and he's in construction, and he hasn't filed a tax return in 30 years. This is how he starts. This is exactly the kind of client you just want this guy. So, okay, hasn't filed a tax return in 30 years. He's up on criminal charges. They want him to go away for 5 years. They want $500,000 from him. That's how he walked into my office. So the side story is that he got a divorce. It was a pretty bloody divorce. His wife took some of the proceeds of the divorce, and she brought a brand new red Fleetwood Cadillac. And while my client was in Las Vegas, plausible denial, the Fleetwood Cadillac was burnt to the ground, to the crisp. The wife knew he did it, turned him into the IRS, and she became the lead witness for the Internal Revenue Service. So I came up with an idea. There's a thing called constructive receipt of money. Constructive receipt. And this guy in the back was asking me about constructive receipt of commission income because he was trying to contort his income and control income from one year to another by having closings occur in the following year rather than this year. Because now we have constructive receipt of money in a different way. And I decided that the wife had constructive receipt of half the money that he made. So I 1099'd her for half the net income of the tax returns. And I was told by people in my industry that I talked to and asked their advice that I would never, ever get away with it. But I did. The guy never did a day in jail. He settled for $125,000 and he walked. So the importance of a 1099, both as an offensive, this was the offensive usage of 1099, and defensive usage of 1099 if you're a property management, 1099s are spectacularly important.
Harold, would they also apply if you had a service provider in your management company who did computer work for you? Would he also have to get the 1099?
Yeah, the only people that are exempt from 1099s are corporations. You don't issue 1099s to corporations. But if they're providing a service to you, I mean, we could talk about you hire a drone photographer to do a drone photography of a piece of property. We're talking about any kind of maintenance or repairs, or you hire somebody to come in and do a showing feng shui. We move furniture around, we're going to do it feng shui, okay? It's a marketing tool. How come we don't know anything about Feng Shui? I think somebody should teach Feng Shui. It's not going to be me. Okay, so how come? So they had to do a Feng Shui. All those people would be issued 1099s. Okay, so we get to slide number 21, which is CYA. When I was on Maui for a year, and I wasn't doing anything. I was playing basketball. I was a terrible basketball player, but I loved the game. And I was playing basketball every day. And my dad called me on January 15th. He was in the hospital. He just had a heart attack. He just bought into a tax practice in Santa Monica. So he says to me, Harold, you gotta fly to LA tomorrow. You gotta sit in my seat and do taxes. I say, hey, Dad, I never did a tax return in my life. He said, get on a plane, come and take over for me. So I flew to LA, and I walked in the next day, the day after, and to his tax practice. And the inside of the waiting room was the inside of an airplane, literally the inside of an airplane. Airplane seats, airplane windows, a curved thing. I'm going, what the hell? Okay, then there were very pretty women who were secretaries that caught my eye, and I was brought into his partner. I was introduced to his partner. His partner was a Latino man, CPA. He was maybe 5 feet tall, and he brought me into his room, and the first thing I see is conga drums. And I'm going, conga drums? CPA? And then there was airplanes hanging from the ceiling. And then you looked at his desk, and he sat on a platform, and his clients were like way down here. And I'm going, this is way too much, man. I go into my office, my new office, my dad's office, and it's like a view. It was on 2nd Street in Santa Monica, the view of the ocean. My dad is the straightest guy in the world. And I'm going, holy mackerel. And in this CPA firm that my dad had bought into was mostly people in the entertainment business. Not the big guys, not any big stars or anything for me to tell you about, but a lot of directors and gaffers and everybody in the industry. And the thing is that the weirder you were, the more they loved it. And I said, I know how to do weird. I can do weird. And the thing in this CPA firm was everybody would go around saying CYA. And of course, it's cover your ass. And I'm going, cover your ass? Well, that meant something to me as a lawyer. Cover your ass, cover your ass. But it means something different to me now. It's not only covering your ass in reference to a tax return, documentation-wise and otherwise. It's playing good defense. And we live in a litigious society. They're breeding lawyers like rats. They're everywhere, okay? And we live in a litigious society. And before the seminar started, I was talking about this guy, Kimo Stone, who came in from Honolulu, gave a seminar. The guy was like a genius. I just love this guy. And he was talking about, because he was a defense lawyer, litigating defense lawyer for real estate professionals. And he was talking about playing good defense. And now there's in your material and not available online is the thing called Cover Your Ass 101. It's the loose leaf thing, okay? We're going to spend a little bit of time on this. Now, when you're in law school, they have a thing called the Socratic method. And we're going to practice a little bit of the Socratic method in the going back and forth. So I need you to like react to this thing. Ready? Deductible or not deductible? It's at the very front of your, should be at the very front of your, I love the mustache, by the way. When I was going to law school, I had a Fu Manchu, like this, Fu Manchu. And I look at pictures of myself at Berkeley and say, who was that guy? I mean, who was that guy, man? My hair was like out to freaking here, and okay, who was that guy? Okay, so you don't need to, if you can't see it, I'll help you on it. Deductible or not deductible? Membership in the Maui Country Club. Deductible or not deductible? Okay, everybody says deductible. However, let's remember that we have kids, and our kids are using Maui Country Club. So not all the dues is deductible because part of it's personal. So if you made an allocation of 75% business and 25% personal, and then the entertainment that you did on your entertainment slips, put the name of clients that you met at the country club, that would be fully deductible. But the dues and the membership fee, if you've got kids and a wife, then you've got a personal portion. So even though your knee-jerk reaction was deductible because you're in marketing, don't be a pig. Let's keep going. Green fees. Partial, depends on whether we're just golfing for fun or whether we're taking out clients. Okay? Now, I had this fantasy that I don't play golf. I don't know anything about it. But I'm sitting there and I've got a 0 handicap and I'm playing a 15 handicap guy that I want to be my client. And I got a putt for $1,000 at the 18th hole, and I miss it purposely, okay? And I lose the $1,000. Deductible or gambling loss? Not deductible, okay? Promotion? Not really. And how would I prove the write-off of the $1,000 of cash that I turned over to the guy? But now he's my client, and I sold him. No, I'm making this up, but I sold him real estate. So it was a really good move that I lost that on the green. Okay, let's keep going. Huh?
Did you have to issue him a 1099?
Very funny. Cindy wants to know whether I would issue him a 1099. He didn't do any services for me, Cindy. He didn't do any services for me. If anything, I did a service for him. Okay, all right. So let's keep going. Food provided by me at an open house. Deductible, right? Everybody cool? Okay, fine. Fine wines used to entertain in my home. Partially. If I have clients over and I entertain a lot, then that portion. But if I'm drinking personally, then it's non-deductible, right? This is the one Roz likes. A professional chef that I bring in to cook for one of my dinners that I hold for my friends who are all clients of mine. I think that's fully deductible. It's all part of my marketing, okay? Okay. Okay, so I buy some artwork and I put it in my office. Deductible? Okay. The office that I use 100% for business. Okay. I buy a boat. Deductible or not deductible? The portion that I use for marketing would be deductible, depreciable, as well as the portion for the cost, the fuel, the bait, etc. What if I use the boat to go down the shoreline and I'm showing oceanfront property in Kihei and McKenna, etc.? It adds to my case, correct? It adds to my deductibility case. So I jump off. I have a client that jumps off tandems off the side of the mountain, you know, and takes people paragliding. And he's dying to take me paragliding. He's this very good-looking, strapping Brazilian guy. And I say, there is no freaking way I'm jumping off the side of the mountain. Okay, but let's say you do. And you go get a GoPro and you attach it to your helmet and you use it as part of your marketing on your website. Deductible, right? But if I didn't do that and I just did it because I turned 60 years old and I wanted to kill myself, then it's personal and it's non-deductible. So number two in this Cover Your Ass deals with the fact that you're putting your tax material together, and we're dealing with foreign travel. Your documents stink. The minute you say your documents are not good or they stink, you've got to get conservative. So you went to Paris. We talked about Paris. International travel is a no-no. You better have the greatest documentation in the history of mankind to write off foreign travel. Now, if you do have the documentation, particularly if it's in people that come to Hawaii, then you've got something to talk about. If you went to mainland China, if you went to Taiwan, if you went to Singapore, these are all potential people, but you better have clients. Now, what they're looking for is a deal. You made a commission by doing this. You not only picked up clients where you did it on the come, but it actually came to fruition. Now, you can argue that it doesn't have to lead to a sale. It can lead to other transactions and other referrals, and I think that's a really good argument. But if it does lead to a sale, then you got almost, it really opens the floodgates of writing off that travel. Yeah.
When our Canadian market, when the Canadian dollar was really strong, and our Canadian market came out, a lot of realtors were going up to Canada, or our travel as realtors would go to the West Coast and business brokerage firms and doing presentations.
Right.
Or even going to the trade shows in China.
Oh, I love that.
So, I mean, even that orientation, even though it doesn't translate into an actual deal, that's gotta be.
Okay, so the question is that this guy's bringing, this gentleman is bringing up, gentleman, look at that, huh? Okay, so it's a white lie. Okay, it's a white lie. It's a packaging issue. This gentleman's bringing up the issue of the fact that many people in Hawaii who are real estate professionals have gone to Canada in order to make pitches and presentations, but then they have documentations of those pitches and presentations. They have maybe videos of them, or they have the people who gave them their cards at the presentations. There's nothing wrong with doing something on the come and spending money in marketing. The issue is verification of the business purpose, that you just didn't go to Toronto to see the Blue Jays play baseball. Okay, so the issue is, what did you go there for? Business? Well, show it. Okay, then I don't have a problem for it. And if you look at some of the issues that we face, we're now almost 2 hours in the presentation, and we're finally getting to you and your clients. So we're all the way to the red lights of dealing with your clients, slide 23. So this is actual stuff that you have to be aware of, okay? So number one, tax issues can be solved after the transaction closes. I actually hear these things. I mean, my eyes roll. I'm always chipping my eyes from the top of my head. Okay, obviously, the best time to deal with a transaction is before it closes, particularly if you're dealing with a sale. You have a client that's selling a piece of property, even if it's a personal residence, particularly if it's a personal residence with a cottage on it or a rental property on it. Hey, there's an issue. If it's rental property, there's no question that there's the recapture of accumulated depreciation and other issues like that. So you get your client particularly your sellers, to a tax professional before the closing, because and not the day before the closing. Okay, please go weeks and weeks and weeks and weeks before the closing, so tax planning can take place. When you hear a client say number 4, you just know there's a problem. There are no taxes on this transaction. Okay? You know there's a problem. I'm going to sell my personal residence that has a rental cottage on it. I'll pay no taxes because I'm using my $500,000 exclusion. Whoops, nip. The $500,000 exclusion applies to my personal residence portion, not to the rental property. I have a big profit on my house, which means principal residence, and I'm going to sell it and do a 1031 exchange. Cannot do a 1031 exchange on a personal residence. I've been renting this property out for a long time. Since I'm selling it for less than I bought it, I'm not worried about my tax liability. Accumulated depreciation. It's in the vocab. You go back to the vocab and you look at the vocab words. Those are the words you have to know. I got the property from my parents as a gift before they died. I'm not going to worry about taxes because the value of the property is decreased versus after their death. Now we're to the issue of basis we're to the issue of basis of property by inheritance versus by gift. And there is a gigantic difference in this area. So I know this is like a Picasso. I mean, those of you who can recognize Picasso, but I'm going to erase it because I want to be able to show this issue to you. So let's take the fact that there are places on Maui, particularly up country where I live, where people could buy No, I don't like that. But thank you for showing it to me. I don't like it. People could buy a piece of raw land for $100 an acre. And we all know that that existed. So a person buys a piece of property for $100 an acre, and they put on a house for $24,900. Their cost basis is $25,000. Years and years and years and years go by, and the husband dies. It's always the husband that dies first because of DNA and stress. Those are the two things that why the husband always dies first. So we have two parts of the cost basis. We have the original cost basis. This is the wife, this is the husband. The wife's cost basis is $12,500. But the value at the husband's death is $500,000. So if you inherit the property, the cost, half of the property gets a step up in basis, so it's $250,000. So what's the cost basis of this property to the wife if she sells it? $262,500. Now the wife dies. No, the wife is still alive because women live a long time. She gives it to her kids. And at the time she gives it to her kids, the property's worth $1 million. What's the cost basis to the donee? She's the donor, she's giving the gift. What's the cost basis to the donee? $262,500. It's whoever gave her the gift, that's the cost basis. The wife now, as we progress, before the property transfers over, she's dead, the value's $1 million, the kids get it with a step-up basis of $1 million. So there is a gigantic difference between whether something is inherited or something is gifted. And in the world that we live in, it's very complex because people play the Medicaid game. So what the Medicaid, it's a game, I use the word game, but I mean it's a strategy. That is that after the husband dies first, the wife's there, then the kids bankrupt the mother. They take all the assets, they gift it to all the kids, the mother's bankrupt, and she has to go into a home or something they put in for Medicaid. There's a 5-year look-back rule, there's all kinds of look-back rules. That's the Medicaid strategy. But if you do that, then you are giving up the inheritance issue of getting up a step up in basis. So that is a complex decision to make depending on a lot of things. Is there home health care insurance, in-home health care insurance that the mother may have? Is there enough money to take care of her so it's not as big an issue? Do we have the portability, which means that now it's $5,450,000 of exclusion per person for estate taxes? So estate taxes is not as big an issue now as when it was $1 million. The unused portion, the husband dies first, the value of the estate is $6 million, so his was $3 million. What happens to the other $2,450,000 of the unused exclusion? There's a thing called portability down here, and this law is down here. Portability, which now has become a big deal. So if the mother gets the portability, now her exclusion is $5,450,000 plus the $2,450,000 that she gets portability from her husband that died first. 7.5 minutes.